All right, welcome. Do you ever stop and wonder how these absolutely massive companies, the ones with offices and factories all over the globe, actually manage to work together? I mean, how do they not just fall apart? Well, a huge piece of that puzzle comes down to something called transfer pricing. It's all about how they price things they sell to themselves. And today, we're going to demystify this whole thing.
Really, it all comes down to a pretty simple question on the surface. Imagine you've got a car company, right? The engine division makes an engine. The assembly division needs that engine. They're part of the same company. So what's the price? How much does one part of the company pay the other? It sounds easy, but oh man, that one little number can turn managers against each other and completely change how much tax the company pays and where. It's a huge deal.
So here's how we're going to break it all down. First up, what even is transfer pricing? Then we'll get into the big puzzle at the heart of it all. After that, we'll check out the different ways companies try to solve it. We'll look at how to handle internal fights, and finally, we'll take it global and see what happens when borders get involved. Let's dive in.
Okay, first things first. What are we actually talking about when we say transfer pricing? Let's lay down the basics.
The easiest way to think about it is like an internal marketplace. You've got one division, say the selling division, and another buying division, all under the same corporate roof. The transfer price is just the price the seller charges the buyer. But that one number, it's everything. It affects the profit and loss sheet for each division, which in turn affects how the managers are judged, what bonuses they get. You get the idea. It's a really big motivator.
And this right here, this diagram, this is going to be our roadmap for the whole journey. See how it all starts with the main idea? That flows right into this thing called the goal congruence problem. We'll get to that in a second. And from there, you see it branch out into all the different pricing methods, what that means for people's behavior, and then the really tricky international stuff. So keep this mental map handy as we go.
Which brings us perfectly to the real heart of the issue. I'm talking about the goal congruence puzzle. Honestly, this is where all the drama comes from.
So here's the fundamental conflict. A manager of, say, Division A, their job, their bonus, their reputation, it's all based on how profitable their division is. Simple enough. But what happens when a decision that makes Division A look great actually hurts the company's total profit? That's the problem. Getting everyone to pull in the same direction, to align those individual goals with the company's big picture goals, that's called goal congruence. And it's the absolute central puzzle we're trying to solve here.
And nothing illustrates this better than a real-world example. So let's look at a company called GL Limited. Their electrical division is humming along, running at full capacity, selling switches to outside customers for 25 rupees a pop. They're making money, everyone's happy. But then, another division from inside the same company, the household division, knocks on the door and says, "Hey, we need those switches. Sell them to us for 18." Now, what do you do if you're the manager of the electrical division?
Well, if that manager says yes, they take a hit. A big one. They lose out on 7 rupees of profit for every single switch they sell internally. Their numbers are going to look awful at the end of the quarter. But, and this is the kicker, if you zoom out and look at the whole company, that internal sale means they can make a lamp that generates an extra 15 rupees of profit. So a decision that's terrible for one division is fantastic for the company as a whole. See the problem? It's a classic.
So, how on earth do you solve a puzzle like that? Well, companies have a whole toolkit of different pricing methods they can use. And of course, each one has its own upsides and downsides. Generally, you see 4 main ways to do this. You could just use the market price, whatever it's selling for outside is the price inside, fair enough. Or you could go cost-based. That could be just the bare bones marginal cost or the full cost with all the overhead baked in. A simpler way is cost plus markup, where you just add a percentage. And finally, you could just lock the 2 managers in a room and tell them to negotiate a price. As you can imagine, each one of these changes the game and what people are motivated to do. Let's put this into practice with another case, a company called Manco. Take a look here. Division A can make up to 50,000 units of, well, whatever this thing is. They've got options. They can sell them outside the company for 80 rupees each, or they can transfer them over to Division B. So the question is, what's the smartest, most profitable move for Division A?
To figure that out, we look at something called the contribution margin for each option. It's basically the profit per unit. So, selling it externally, you make 15. That special order, also 15. A small transfer to Division B, still 15. It all looks the same, right? But check this out. Look what happens if Division A agrees to give Division B its entire order of 45,000 units. The contribution per unit suddenly jumps up to 20. Ding, 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 we have a winner.
So what's the bottom line? By making that one smart choice, what does it all add up to? A total profit for Division A of 395,000 rupees. In this case, choosing the best option for the division also happened to be the best option for the company. A perfect win-win.
But it's not always that neat and tidy. What happens when the numbers don't line up perfectly? That's when you have to pull out some more advanced strategies to keep things fair and make sure everyone stays on the same team.
And this is where accounting gets really clever. Check this out. One method is called a dual rate system. It's almost like a magic trick. The company lets the selling division record a nice, high, profitable price on its books. Makes the manager look great. At the same time, it lets the buying division record a super low cost on its books. It's like they're living in two different realities, but it works. Everybody's happy. Then there's the two-part system. Here, the buyer pays the rock-bottom minimum cost for each item, but they also pay the seller a separate flat fee to help cover their overhead. It's another smart way to make the numbers work for everyone.
Yeah, this really sums up the genius of that dual rate system. The seller books a profit, the buyer books a minimum cost. It's designed specifically to make both managers feel like they're being graded fairly and that they're winning. And when both sides feel good about the deal, they're much more likely to cooperate. And that cooperation, that's how you finally achieve that all-important goal congruence.
Okay, so everything we've talked about so far has been inside one country. But now, let's raise the stakes. What happens when you've got divisions in different countries, with different currencies, different laws, and this is the big one, different tax rates? Suddenly, this isn't just an internal puzzle anymore. It becomes a high-stakes game of global financial chess.
So let's take a look at this scenario. We've got a car company with an engine division based in India, where the corporate tax rate is 30%. They're selling those engines to the company's assembly division over in Italy, where the tax rate is a much higher 40%. Now, from a pure operations standpoint, this internal sale makes sense, but the real question is, does it still make sense once the tax man gets involved?
So to figure this out, we're just going to follow 3 simple steps. First, we'll calculate the after-tax gain for the team in India. Then, we'll figure out the extra after-tax cost for the team in Italy. And finally, we'll put them together and see what the net benefit, or cost, is for the company as a whole. Simple.
And here's how the math shakes out. The division in India, they make an after-tax gain of 4.2 million rupees. Not bad. But for the division in Italy, buying internally means they have an extra after-tax cost of 3 million rupees compared to just buying locally. So, you've got a gain on one side and a cost on the other. Is this deal actually worth doing?
Oh, absolutely. When you put the gain and the cost together, the company as a whole is better off by 1.2 million rupees. This is a textbook example of how huge multinational companies can use transfer pricing not just for internal accounting, but as a powerful financial strategy to legally minimize their global tax bill. It's less about bookkeeping and more about strategic planning.
So that kind of leaves us with one big question to chew on, doesn't it? After looking at all the conflicts, all the math, all the global strategies, is the best transfer price really just a number you find in a spreadsheet? Or is it something more human? Is it really about negotiation, about psychology, and finding that perfect balance that makes everyone on the team feel like they're moving forward together? Definitely something to think about.